Greetings everyone, Joseph James here, and I want to go over a technique that we use in the live trade room every day, but it's still something that we find a lot of our members and our trial members still have questions about, and that is higher highs and lower lows, how we use them in our trading, why they're important, and ultimately guys, I want to remind you first of all that our mission as a trader is relatively simple. It is to participate in the market when it moves, and then of course to avoid the market when it does not, right? The trend is our friend. We want to trade with the trend, but of course we want to avoid sideways, range-bound markets. In other words, as a day trader, we make money when price moves. So we want to trade in a market that is moving or participate in a market when it's moving, and then avoid the markets that are, or a time period within the market that shows sideways or markets that are not moving at all. Right, now let's talk about what higher highs or lower lows are. Well, they're going to give us confirmation that the market is indeed breaking out of a pre-existing trading range. So that sideways range-bound market that I was talking about, how we want to avoid it, well, a higher high or a lower low is going to give us visual confirmation that the market is breaking out of, in other words, it is moving now. It's going to provide us with more information about this overall sentiment in the market. We always talk about how we're looking for the market to tell us something. We're looking to read what the market, or is tune into what the market is trying to tell us. And of course the market gives us certain things inside of price action, price patterns, looking at the time and sales window, reading volume, right? Those are some of the footsteps or the signs that the market gives us to try to communicate with us about what the sentiment is. Well, seeing a higher high or a lower low is one of those tools that we use. This would be a price pattern or a candlestick pattern. The way in which price is trading, making a higher high or a lower low, it'll provide you with more information about the sentiment in the market. And of course, for us James Wave traders, this means entry opportunities. One of our rules specifically, which we go over in our live trade room every day, talks about how we have to see higher highs or lower lows before we enter the market. So it's going to give us entry opportunities as well. And of course, one of the great reasons why we use this is for trade management, and that is it can be used for your profit targets and your initial stop placement. Oftentimes, we will use your initial stop, we'll use higher highs or lower lows as a way of placing our initial stop, with the idea that if price is breaking out of, all right, in other words, if it's making higher highs or lower lows, that may signify that we've made the wrong decision. So if you're in a long trade, placing a initial stop just below the most recent lower low may, of course, give you a little bit more or a more accurate position in the market to exit if price does make a lower low when you're in a long position, and of course, vice versa if you're short. It's also one of the most fundamental price patterns that we can use as traders. Now, as traders, we have universal tools that we all use, Fibonacci numbers. We use things such as higher highs or lower lows, different price patterns that all of us traders use. This is one of those very fundamental price patterns that we use as day traders, higher highs and lower lows. And of course, this technique of seeing higher highs or lower lows, it can be used on any time frame and on any market. It does not need to be a futures market or a stock market or a forex market. It can be anything, guys. And ultimately any time frame, whether or not we're looking at higher highs or lower lows on a daily chart, or all the way down to possibly a 55 or a 13 tick chart. So it can be on any time frame we're looking at these higher highs and lower lows. Now let's talk about the overall structure of what this looks like. Now this is going to be a long example where price is moving up. The first step is we see price makes its initial move up. So whether or not this is breaking out of consolidation or not, it just means at this time price is moving up. Now the second step is that it will then pull back from this moment. All right, so we have a strong move up or initial move up, and then a slight pullback for a moment. That makes that higher high level. All right, see the top of this price pattern here? That is going to be where my new higher high is, because number 3 here is because then it will return to its short-term trend. So number 1 is where price moves up. Number 2 is where it pulls back a little bit. Number 3 then, of course, is where it returns to its short-term trend. And of course, as you can see in this illustration, the higher highs were achieved when the price breaks the most recent high. And of course, that's circled or with that yellow box and that red arrow. So that initial move up followed by the pullback, then our new higher high is achieved on step 3 when it violates or when it breaks through that red horizontal line there on your screen. All right, so let's take a look at both higher highs or lower lows. As you can see on your screen, left side is the higher highs. We make higher highs whenever we break that horizontal yellow line, and I've circled it with these white boxes. All right, so you can see here 2 examples going up of how the initial move up, a slight pullback for just a moment, and then we return to its upward trend, making higher highs. Now, if for some reason price did not break above those horizontal yellow lines, it would not be considered a higher high. And of course, the opposite is true on the right side of your screen for a lower low. As price is moving down, the initial move down is followed by a brief pullback off of those lows. Only then, step number 3 is then to have price continue back down to the downside, breaking those lower lows, which are marked by that the green arrows there on your screen. And this, of course, is 2 examples of 2 lower lows. If in these examples, if price hadn't broken below those yellow dot, those horizontal yellow lines, then of course it would not achieve lower lows. All right, let's take a recap real quick. Lower lows and higher highs, these are fundamental patterns that we see in any market and any time frame. It's going to confirm market sentiment. And again, what I mean by that is if we think that price is moving up, then we need to see higher highs. Conversely, if we think price is going to be moving down, we need to see lower lows. If I'm in a trade and I want to know if price is going to continue to the downside, I would be looking for lower lows. Let's say I was in a long trade and I want to decide if I want to take profits early or if I want to let my trade run. Well, in a long trade, if we're making higher highs, then that tells me that the sentiment in the market is saying this market is moving up. The buyers are there, they're making new higher highs, and therefore, if I'm in a long trade, I may want to hold on until I start seeing the market have the inability to make higher highs or even start to make lower lows. So it's going to give us that confirmation of the overall market sentiment. We know the traders want price to move up when we're making higher highs. We know the traders want price to move down when they're making lower lows. If they're not making either, if we're not seeing higher highs or lower lows, then that of course indicates a market that is moving sideways and has no direction up or down. All right, it's going to give us entry opportunities as James Wave traders. In fact, if you guys join us in our live trade room at 7:30 a.m. Eastern Standard Time each day, you'll see that we use higher highs or lower lows as one of the vital tools of entering the market. And then we can also use higher highs and lower lows for places to place our initial stop loss and to put our profit targets. Not to mention, it's one of the reasons why our methods work on all different types of markets in any time frame. Now, we always say to you guys that the James Wave method of trading, it works with the fundamentals of each individual market, and of course that's why it's such a universal system. Well, this is just one of those reasons why the James Wave method will work in any liquid market on any time frame, is because we have key fundamental patterns woven into our methodology, just like these higher highs and lower lows, which means whether I'm trading the S&P or the DAX or the bonds, the T-notes, corn, wheat, soybeans, the euro, the pound, or the yen, or even the mini Dow and the Russell, guys, it's all going to work with the James Wave method of trading. All right, guys, this is what we call higher highs and lower lows. My name is Joseph James. Hope the video helped, and we'll see you tomorrow in our live trade room, 7:30 a.m. Send us an email for more questions, sales@schooloftrade.com, and we'll see you next time.